Welcome students to the series of lecture on fixed income. And in the series of lecture of fixed income, today we are introducing a new topic to this series, that is optionality in the bond. And specifically, we are talking about two bonds in this category, that is callable bond and puttable bond. So the discussion is about callable bond and puttable bond, and we are introducing optionality in the bond. Okay. First of all, let's try to understand what is a normal bond. What is a normal bond? And with the help of a normal bond, we'll contrast and understand what is a callable bond and what is a puttable bond. Okay. First of all, let's answer this question, that why any organization or any bond issuer, any organization or any issuer issues the bond. They issue the bond because they would be in a need of cash, and they can have capital or cash either through the route of equity, as in they can issue equity, or they can go and have loan. And very similar to loan is bond. So a bond issuer need cash, or an organization need cash, or a corporate need cash. They can issue equity and can have cash or capital, or they can go to a bank or an organization to have loan. They can have loan, or they can directly issue the bond. So bond and loan are of similar category, because that will lead to a liability on the organization. So loan is a liability. Similarly, bond is a liability to the organization. So a bond issuer will issue a bond, and say the characteristics of the bond are face value 1000, coupon 6%, maturity 3 year, and coupon frequency annual. If they issue the bond, the bond buyer will purchase the bond and pay the price of the bond, the should be price of the bond or the market price of the bond. By valuing it correctly, they will pay the price of the bond, that is cash. So a bond issuer will have cash and also a liability, because they have issued a bond. So that is the reason that why any bond issuer issue a bond, because they would need capital, they would need cash. Very simple reason. Now, how would you know the price of the bond? The price of the bond would be calculated based on the characteristics of the bond. Face value 1000, coupon 6%, maturity 3 year. Say the interest rate in the market is, say, 7%. If the interest rate in the market is 7%, definitely this bond will be trading at discount. Okay. Let's calculate the price. Let's calculate the price of the bond. Second clear work, second clear TVM. 1000 FV, PMT is 60. 7 is I by Y, 3 is N, compute PV, 973.75. This is the price of the bond. Now, this is what the bond issuer will receive, but this is the cash as an asset, but this will lead to a liability of 973.75. And how bond issuer will pay the liability? Bond issuer will pay the liability by paying 60, 60, 60, 60 as a coupon and 1000 as the face value. Okay. Now, let's talk about callable bond and understand with the contrast with a normal bond. So what is a callable bond? Almost identical to normal bond, a bond issuer will issue a callable bond. A callable bond will have certain characteristics, and the bond buyer will pay the price. Now, here the face value is 1000, coupon is 6%, annual maturity 3 year. These are the characteristics of the bond. But this time the price of the bond is not going to be 973.75, and we'll discuss about it in detail. But what make this bond a callable bond? What is the characteristics of a callable bond? The characteristics of the callable bond is issuer has a right. What? The bond issuer has a right to buy back the bond at a predetermined price, and the price could be, say, 900. So issuer has a right to buy back the bond at a predetermined price. at a predetermined price. From whom? From the buyer. He has the right, not an obligation. And bond buyer has an obligation to sell. Bond buyer has an obligation to sell. So who has the right, who has the option to buy whenever he feels like? It is the issuer. If issuer wants to buy, the bond buyer has to sell at 900. If bond issuer do not want to buy, if bond issuer do not want to buy back the bond buyer cannot sell the bond. This is a callable bond. Now, what you felt as a bond buyer, what you felt about this bond? Have you got a good feeling or a bad feeling? You're getting an obligation. You're getting an obligation that the bond issuer can come and buy back the bond forcefully whenever they feel like. It's a bad feeling. So the price of the bond is definitely not going to be 973.75. You will perceive it as a bad bond and the price would be lesser than 973.75. Okay? The price of a callable bond with the same characteristics as the normal bond will always be lesser than the normal bond. Okay. What about puttable bond? What about puttable bond? Again, you have bond issuer. Again, you have bond buyer, bond issuer, bond buyer. Bond issuer issues a bond and it is categorizing it as a puttable bond where the face value is 1000, coupon is 6%, maturity 3 year. Any characteristics of the bond would be there. I have taken identical characteristics to make you understand that, hey, the price of a normal bond would be different than the callable bond and the puttable bond for the same characteristics. And that is the reason I have taken identical characteristics. Okay. Again, the bond buyer is going to pay the price of the bond. But what is the characteristics of a puttable bond that is different than the normal bond? That is written here that issuer has an obligation. Has an obligation. So who has the right? The buyer has the right to sell the bond at a predetermined price. Say the price is 900 again. Even the buyer has the right to sell the bond at a predetermined price, which is 900. Still, the bond buyer has the right. If the bond buyer feels like selling the bond back to the issuer, then issuer has the obligation, they cannot run away, has the obligation to buy back the bond at the predetermined price of 900. So as a bond buyer, you felt good slightly or bad? Good. So what should be the price of this puttable bond? Higher than the normal bond? Because you are getting an additional feature than normal bond as a bond buyer. You can sell the bond back to the issuer whenever you feel like. Why it is a good feature? Assume in the market interest rate goes to 30%. Calculate the price of the bond at 30%. Let's calculate it. 30 I by Y compute PV 564. 564 would be the price of the bond, but you have the right to sell the bond back to the issuer at 900. It is a good feature. So bond buyer will start perceiving this bond as a good bond. So the price of a puttable bond would be higher than the price of the normal bond, and the price of a callable bond would be lower than the price of a normal bond. So if I have to write it, the value of a puttable bond will always be greater than value of a normal bond will always be greater than the value of a callable bond, where the feature of the bonds or the characteristics of the bond are identical. I'm repeating, what is a puttable bond? A puttable bond is a bond where you have an additional feature as a bond buyer. You can sell the bond whenever you feel like, and issuer has an obligation to buy the bond if you want to sell the bond. And in callable bond, the issuer has the right to buy back the bond whenever they feel like buying back the bond. So this was the introduction of callable bond and puttable bond, or you can say that this was the introduction of optionality into the fixed income series. In the next sessions, we'll try to understand that how the callable bond and puttable bond convexity get impacted. Okay. With that, I'll pause here. Thank you. Have a nice day.